Welcome to Griffonomics. Today we're diving into SOLV Energy, Inc., trading under the ticker MWH.
Thanks for having me. It's great to be here to dig into this one.
Yeah, I'm really excited about this. So imagine a massive, multi-billion-dollar AI data center. Just picture it.
Right. Huge facilities.
Exactly. It's a modern marvel of engineering. You have, thousands of the most advanced silicon chips humming in unison, training the next generation of artificial intelligence, processing just trillions of calculations per second.
The absolute bleeding edge of human innovation, basically.
It is, and yet this entire technological cathedral is completely useless. Literally a multi-billion-dollar paperweight if the sun goes behind a thick cloud and the power grid flickers.
Yeah, without power, it's all just expensive metal and plastic.
Exactly. We spend all of our time talking about the software, the algorithms, and the microchips of the intelligence age. But today, we have an absolute mountain of source material to look at the physical foundation beneath it all.
We've got the Q2 2026 earnings transcript, full 10Q SEC filings, a forensic Q&A audit, and some really detailed investment thesis memos.
Right, a massive stack of sources. And we are looking at a construction contractor. Now, I know what you, our listener, are thinking.
They're probably wondering why we're talking about concrete and steel on a show that covers the AI supercycle.
Exactly. You hear construction company and you wonder why on earth we are talking about dirt and wiring. But we are going to show you exactly why a company pouring concrete and wiring high-voltage lines might just be the most unappreciated, deep-value opportunity hiding in plain sight.
It really is hiding right there in the open.
Okay, let's unpack this.
I think that framing is exactly right, though. I mean, if you want to understand the future of technology, you really have to look at the physical constraints of reality.
Right, the physical bottlenecks.
Exactly. And right now, the biggest constraint on the AI revolution is simply electricity.
Just getting enough power to the right places.
Yep. We are looking past what I would characterize as, transient post-IPO noise with this company.
Because they just went public recently, right? February 2026.
Correct. And since SOLV Energy went public back in February, the stock has experienced a lot of churn, just a lot of volatility.
Which is pretty normal for a newly public company.
Very normal. But if you actually take the time to look under the hood, if you read the SEC filings rather than just staring at the stock ticker, you start to understand the actual mechanics here.
The nuts and bolts of what they actually do.
Where it's a debt-free infrastructure pure play that is sitting squarely at the intersection of the North American power grid supercycle.
And it really just requires a calm, analytical look at the numbers to see what is genuinely being built here, right? Because the numbers coming out of this second quarter are honestly staggering.
They're massive.
I was reading through the top-line revenue figures, and I had to double-check to make sure I wasn't misreading the decimal points. Let's start with the sheer velocity of the revenue here.
The top-line explosion.
Yeah, we are looking at a massive financial beat for Q2. Their revenue surged 77.5% year over year.
Which is almost unheard of for a heavy construction firm at this scale.
Right. That brings their single quarter revenue to $951.2 million.
Nearly $1 billion in a single quarter.
And they beat Wall Street consensus estimates by $232.5 million in one quarter.
Just blew past the estimates.
Yeah. And if you aggregate that, their first half 2026 revenue is an incredible $1.628 billion.
For a company that just recently went public, putting up a near $1 billion quarter is a massive statement to the market.
It is, but, when I see a top line explode like that, my first question is always, is this real sustainable business or is it financial engineering?
Oh, for sure. Are they just juicing the numbers?
Exactly. Like, are they just selling off assets to make the quarter look good?
It is a phenomenal top-line result, and your skepticism is totally warranted. In the infrastructure space, you often see companies masking poor operations with one-time asset sales.
Or weird accounting adjustments, right?
Exactly. But when we audit where this revenue is actually originating, it paints a very clear picture of sustainable acceleration.
So where is it coming from?
95.9% of that total Q2 revenue came directly from new construction activity.
Wait, almost 96% is just pure new construction.
Pure construction.
Sure.
This is heavy, physical, real-world deployment. They have boots on the ground, driving steel beams into the earth, laying miles of specialized electrical conduit.
Actually building things.
Yes, physically erecting massive utility-scale solar and battery storage plants.
Okay, so it's mostly just raw construction volume. What about the other 4.1% then?
The remaining portion is largely a combination of their recurring operations and maintenance business, which we will definitely explore later, and the integration of some highly strategic recent acquisitions.
Got it. So the acquisitions are chipping in a bit.
Right. Those newly acquired entities are now fully operational under the SOLV corporate umbrella, generating meaningful revenue streams of their own.
But the main takeaway is that the nearly 80% growth is real execution, not tricks.
Exactly. It's being driven by fundamental execution in the field, not back-office accounting tricks.
Okay, so the top line is a rocket ship. The revenue is real, physical construction. But here's where I need you to act as a forensic accountant for us, because reading the 10Q gave me immediate whiplash.
Yes. The margins.
Yeah. We have this optical contradiction that is practically screaming off the page. The revenue surged by nearly 80%, but the gross margin absolutely plummeted.
It looks really bad on a surface level.
According to the SEC filings, their GAAP gross margin fell from 21.1% in Q2 2025 all the way down to 14.7% in Q2 2026.
That's a steep drop.
And their adjusted gross margin showed a nearly identical plunge, dropping to 15.2%. I mean, if I'm an investor looking at these metrics, I am instantly hitting the panic button.
Which is the natural reaction, sure.
Right, because it looks like the classic dangerous scenario where a company is buying revenue at the expense of profitability.
Like they're taking on bad jobs just to show growth.
Exactly. They are taking on low-margin junk contracts just to show top-line growth to Wall Street. So walk us through the accounting anatomy here. Is this a fundamental flaw in their pricing strategy, or is there something mechanical happening behind the scenes?
Put away the panic button. Honestly, this is arguably the most misunderstood aspect of their current financial profile.
Really? Just completely misunderstood?
Completely. It is a classic case of accounting mechanics masking underlying operational strength. When you run a true forensic audit on that margin compression, we can isolate it to three highly specific drivers.
Okay, 3 drivers. Let's hear them.
Once you understand the mechanics of these 3 drivers, the panic completely subsides. Let's take them one by one.
Let's do it. What's the first one?
The first driver is simply a prospective accounting reclassification regarding their compensation structure.
Okay, so moving money around on paper.
Basically, starting in the second quarter of 2026, SOLV made a formal shift in how they report their annual incentive bonus expense.
Like employee bonuses.
Yes. Historically, this bonus expense was part in selling, general, and administrative expenses, or SG&A.
Gotcha.
But they made the decision to move that expense directly into the cost of revenue.
Okay, let me stop you there to make sure I'm translating this correctly. SG&A is essentially the corporate overhead, right?
Exactly. The corporate bloat, so to speak.
The executive salaries, the back office software, the rent for the headquarters. And cost of revenue is the direct physical cost of delivering the product, the steel, the concrete, the field labor.
You nailed it.
So they took the annual bonuses and moved them from the corporate overhead bucket into the direct project cost bucket.
Exactly. It is purely geography on the income statement.
But logically, by moving it into the cost of revenue bucket, it artificially inflates the cost of delivering the projects, which mathematically shrinks the gross margin.
Precisely. Because they push those bonus dollars up the income statement into the cost of goods sold, it creates an immediate 60 basis point headwind to the gross margin calculation.
Oh, wow. So just 0.6% has gone purely from that.
Right. It makes the gross margin look optically worse by 60 basis points right off the bat.
But it doesn't actually change the cash they have.
Not at all. And CFO Chad Plotkin was very explicit about this on the earnings call. He stressed that this move has absolutely zero impact on net income, zero impact on adjusted EBITDA, and zero impact on actual free cash flow.
Because the money is leaving the company's bank account either way.
Right. They just changed which line item it gets recorded on.
Okay, so driver number 1 is literally just moving the furniture around the living room. It changes the look of the room, but you still have the same amount of furniture.
Great analogy, yes.
What is the second driver dragging down the margins then?
The second driver is what we call tough prior year comparables.
Meaning they had a really good quarter last year that they're being compared to.
Exactly. When you calculate year-over-year growth, the math is entirely dependent on what happened exactly 12 months ago.
Right.
If you look back at Q2 2025, SOLV's margins were artificially inflated by 2 specific non-recurring events.
What kind of events?
First, They executed a significant amount of emergency storm and equipment repair work during that specific quarter.
Ah, and I'm guessing emergency work pays a premium.
A massive premium. Emergency response work in the utility sector commands incredibly high pricing, which drives up gross margins dramatically.
Makes sense. If the power lines are down in a storm, the utility will pay whatever it takes to get them back up right now.
Exactly. And second, they finalized some legacy development asset sales that closed in Q2 2025.
They sold off some assets.
Right. And when you sell an entire developed asset, the margin profile on that one-time transaction is exceptionally high.
Right, so those two factors artificially spiked the 2025 margin up to that lofty 21.1% level.
Yes, it was an unusually high baseline.
And because there were no major emergency storm repairs or asset sales this quarter, the year-over-year comparison looks artificially punitive.
Exactly. It makes normal operations look like a decline.
It is like comparing my income in a normal working month to a month where I unexpectedly inherited $10,000 and sold my used car.
Yeah, that's exactly how it works.
If you compare those 2 months, it looks like my income completely collapsed, even though my normal salary from my job stayed exactly the same. The baseline didn't change. The comparison is just warped by a one-time anomaly.
That is a very accurate way to frame it. You simply cannot judge the core business trajectory based on anomalous spikes.
Okay, so that's the bonus reclass and the tough comps, but those don't explain the whole drop.
You're right. While those first two drivers are important context, they are not the primary culprits. The sources, specifically the institutional investment memos, flag the third driver as the real key to understanding this stock.
Okay, hit me with it. What's the third driver?
We have to talk about percentage of completion accounting.
Oh boy, I have read through this section 3 times in the prep materials, and this is where it gets incredibly dense. Can you break this down for us?
I will do my best, yeah.
How does percentage of completion accounting actually work in the real world, and why is it dragging down SOLV's gross margins so heavily right now?
This is the absolute most crucial mechanical driver for anyone attempting to evaluate SOLV's true valuation.
Okay, so pay attention, basically.
Definitely. So in the second quarter of 2026, approximately 75% of SOLV's new construction revenue originated from mega projects that were less than 50% complete.
3/4 of their work is barely half done.
Exactly. Now, in large-scale, multi-year infrastructure construction, companies cannot wait until a 3-year project is entirely finished to recognize the revenue.
Right, they have to report earnings every quarter.
Yes. They use percentage of completion accounting. This means they recognize revenue and profit progressively as the project is built.
Okay, that sounds logical. If you're a quarter done, you book a quarter of the revenue.
But here's a catch. When a massive mega project is in its early stages, say 20 or 30% complete, the company is required to recognize that revenue based on very conservative baseline budgeted margins.
Wait, why do they have to be so conservative early on? Why not just estimate the final profit and book it immediately?
Because in heavy civil engineering, the unknown variables are massive. When you are only 20% into a build, the primary execution risks are still entirely ahead of you.
Like what? What could go wrong?
You don't know if you are going to hit an unexpected shelf of solid granite while drilling the foundations. You don't know if a hurricane is going to wipe out 2 weeks of your construction schedule.
Oh, I see.
You don't know if there will be a localized labor strike or a supply chain bottleneck. Because of these immense unknowns, the accounting standards basically force companies to hold back substantial contingency reserves.
Just in case things go sideways.
Exactly. They model these early-stage margins incredibly conservatively. For SOLV, those early-stage baseline margins are typically modeled around 14 to 15%.
Okay, let me try to translate this into an everyday scenario to make sure I'm grasping the mechanics.
Go for it.
Let's say I hire a general contractor to do a massive $100,000 kitchen remodel.
Okay, classic example.
We sign the contract and they expect to make a 20% profit overall, so 20 grand. In the first few weeks, they are ripping out the old cabinets and tearing up the floor. They are maybe 20% done with the job.
Right. Early stages.
At that point, they aren't going to tell their own accountants that they have locked in that full 20% profit rate yet.
Because they don't know what's behind the walls?
Exactly. Because they know that when they open up the drywall, they might find black mold or faulty wiring or a leaky pipe that just destroys their profit margin.
Yep, the hidden risks.
So they hold back a massive chunk of their expected profit as an emergency fund, a contingency reserve. They only claim a baseline profit on their books, say 10%, just to be safe.
That is an excellent analogy. The black mold in your kitchen is the unexpected bedrock on a solar farm. The contractor is just protecting their downside.
Okay, so that makes sense while the product is happening.
But what's fascinating here is what happens as the project matures. Let's follow your kitchen analogy to the end. The drywall is up, the cabinets are installed, the countertops are perfectly in place. You are 95% finished. The risk of finding black mold or faulty wiring has completely evaporated.
Because everything is already built.
Exactly. The execution risk is burned off.
Right. So if they didn't need to spend that emergency fund fixing black mold, that money doesn't just disappear, it goes straight into their pocket as pure profit at the very end of the job.
Exactly. And that is exactly what happens with SOLV's accounting on a scale of hundreds of millions of dollars.
Wow.
As these massive mega projects cross the 75% to 100% completion threshold, the unspent contingency reserves are released.
And they aren't just released as revenue, right?
No, they are released directly into gross profit. It creates a massive margin spike at the tail end of the project lifecycle.
So connecting this back to their Q2 numbers, 75% of their current revenue is originating from projects that are in the early, risky phase, the phase where they are tearing up the floorboards and hoping they don't find mold.
Yep, the initial heavy lifting.
Therefore, the entire company's blended gross margin is being temporarily anchored down by these conservative 14 to 15% baseline estimates.
Yes, it is fundamentally a timing mechanism. It's not a structural deterioration of their pricing power at all.
So the profits are basically just delayed.
Exactly. As this current massive cohort of early-stage mega projects continues to mature, finishing up late this year and accelerating aggressively into 2027, all of those contingency releases are going to flood the income statement.
Which means the margins will shoot back up.
The investment memos model that this will expand their blended gross margins back toward a normalized 17 or 18%.
Okay.
Which subsequently drives their adjusted EBITDA margins above 13.5%. The margin drop you saw in Q2 isn't a red flag indicating distress. It is a coiled spring.
A coiled spring. I love that.
The tension is building, and the profit realization is just deferred to the back half of the project timeline.
That completely changes the narrative around the stock. If that margin compression is just a temporary illusion caused by the sheer volume of new projects they are starting, then the obvious next question is, what exactly are they building?
We need to look at the backlog quality.
Right, the backlog quality and the physical scale of these projects, because the scale of what they are undertaking right now is honestly hard to fathom.
It's massive.
Their total backlog hit a record $8.6 billion at the end of the second quarter.
Nearly $9 billion.
That is a 44% year-over-year expansion. $9 billion in future work. Can you map out exactly what is inside that pie chart for us?
Absolutely.
Because, not all backlog is created equal, right? Some of it is just a handshake agreement, and some of it is ironclad.
You are absolutely right. And dissecting the backlog quality is a primary exercise for any institutional investor because it dictates the company's revenue visibility for the next 2 to 3 years.
If the backlog is fake, the revenue projections are fake.
Exactly. A massive backlog number is meaningless if the contracts can be canceled on a whim. So let's break down that $8.86 billion. What's the biggest piece? The largest slice of the pie, representing 53%, is what SOLV classifies as awarded backlog.
What exactly does awarded mean in legal terms? Like, is it legally binding?
It means they have won the competitive bidding process, the customer has agreed upon the overall pricing structure, and they have signed what is called a limited notice to proceed, or LNTP.
A limited notice, meaning they can't just send out the bulldozers yet.
Correct. Under an LNTP, SOLV is authorized and funded to begin the critical initial phases.
So they're getting paid, but just to prep.
Right. They're conducting the complex site engineering, securing the specialized long lead equipment, and finalizing the supply chain logistics. But they are waiting on the final unconditional notice to proceed to mobilize the heavy machinery and actually break ground.
Okay, so that 53% is essentially locked in. The relationship is formalized. They are just doing the expensive prep work before the real dirt starts moving.
Exactly.
What is the next slice?
The next 40% is classified as signed backlog. This is the gold standard.
Signed.
Yes. A full notice to proceed has been issued. The project financing from the utility or developer is fully closed, and these are firm remaining performance obligations.
Which means they are actively building it.
For SOLV, that signed backlog sits at a massive $5 billion.
Wow.
That is $3.5 billion of locked revenue that is actively being constructed and will burn off into their income statement over the next 12 to 18 months.
Okay, so between the awarded and the signed, we are accounting for 93% of the backlog. Both very solid. What makes up the final 7%?
The remaining portion shifts from active construction to operational annuity.
Like maintenance.
Yes. 4% consists of long-term operations and maintenance contracts, their O&M division, and the final 3% is estimated corrective maintenance and repair work on those existing sites. This is highly visible recurring revenue.
Okay, so the contractual structure of the backlog is incredibly solid. But what really jumped out at me in the investment memos was the physical evolution of what they are actually building.
The shift in scale.
Yeah, the sources detail a dramatic shift in their strategic focus toward mega projects. They are no longer just building small solar farms in a suburban field. They are building massive industrial complexes.
The scale evolution is arguably the most important operational shift the company has made.
Really? More important than the financials?
In terms of operations, absolutely.
Yeah.
If you rewind just a single year, looking at Q2 2025, the average new project origination size entering SOLV's backlog was roughly 200 megawatts.
Well,
By Q2 2026, that average had more than doubled to approximately 450 megawatts.
doubled in 1 year. And to give you a sense of scale, our listeners might not know this, but a single megawatt of solar requires roughly 5 to 7 acres of land, depending on the topography.
Right, it takes up a lot of physical space.
So a 450 megawatt project isn't just a field, it can cover nearly 3,000 acres. It is a sprawling industrial footprint.
It's massive.
And that is just the average size. The memos detail specific mega installations that are currently under construction that dwarf that average.
Right, the real giants in the backlog.
We are talking about a massive 1,200 megawatt DC build in Arizona across multiple phases.
1.2 gigawatts, that's huge.
This project includes the solar arrays, the heavy battery storage integration, and the complex SATA fiber optic networks to control it all. That Arizona project is the largest single award in the company's entire history.
A record breaker for them.
Then they have a 1,150 megawatt build across 2 distinct phases in Texas, and a 650 megawatt facility in North Carolina, which involves not just the panels, but building the high voltage substation and the massive transmission lines to tie it into the grid.
That North Carolina project is actually the largest single solar installation on the entire East Coast.
I want to emphasize your point about scale.
Yeah.
These are not simply fields of glass reflecting the sun.
No, not at all.
These are multi-billion-dollar, highly complex, dispatchable power generation facilities. Their electrical output and their grid impact rival traditional fossil fuel peaker plants or even mid-sized nuclear reactors.
Oh, yeah.
They are fundamentally altering the energy architecture of the regions they are built in.
They really are.
I have to push back a bit here, though.
Sure.
If I am an investor analyzing execution risk, and I see a company shifting from building 200 megawatt projects to 1.2 gigawatt mega projects, I start to worry about operational bloat and catastrophic failure.
Too big to manage, essentially.
Yeah, right. Does building a 1.2 gigawatt project inherently carry more execution risk than building 5 smaller 200 megawatt projects? It seems logical that if something goes wrong on a 3,000-acre site in Arizona, it goes catastrophically wrong and tanks the entire quarter's earnings.
It is a completely rational concern, and honestly, in many industries, that logic holds true.
Right. Diversifying your risk.
But in the heavy EPC world, engineering, procurement, and construction, the mathematical reality works in the exact opposite direction.
How so?
Executing these 600 megawatt to 1.2 gigawatt mega installations is actually the holy grail because it unlocks what we call permanent fixed cost operating leverage.
Operating leverage. Explain how that actually works on the ground. Walk me through a site plan.
Let's do the comparative math. Think about the physical and administrative overhead required to manage a single construction site.
Okay, picture the trailers and the foreman.
Exactly. If SOE decides to build 5 separate 200 megawatt projects scattered across 5 different states, say one in Nevada, one in Utah, one in Ohio, one in Georgia, and one in Florida.
Okay.
For each of those 5 sites, they have to hire 5 separate elite project managers. They have to lease and set up 5 separate field engineering trailer complexes.
That's a lot of duplicate work.
They have to design and manage 5 entirely separate supply chain logistics routes for the steel and equipment. They have to navigate 5 different county permitting offices, and they have to maintain 5 distinct sets of regional corporate overhead to oversee it all.
That sounds like an administrative nightmare, duplicating the same effort 5 times over.
It is incredibly inefficient. Now, compare that to building one massive 1-gigawatt site in a single location in Arizona.
Same amount of power, just one location.
Right. You only need one central command structure. You have
Yeah.
one master project manager, one consolidated engineering hub, one centralized supply chain route coming off the highway, and one regional corporate oversight team.
Ah, I see.
You are taking all of that fixed site engineering, project management, and corporate overhead and spreading it across a vastly larger revenue baseline.
So the cost per megawatt just plummets.
Exactly. Delivering a massive project requires substantially less per megawatt overhead. It permanently lowers their SG&A expenses as a percentage of overall revenue.
Which means higher profit margins overall.
So as they shift their entire backlog toward these mega projects, their fundamental profit margins inherently expand because they are stripping out the redundant administrative fat.
Okay, that makes perfect sense. Bigger is actually leaner when it comes to the bottom line, assuming the engineering team can handle the complexity.
Which SOLV has proven they can.
Now, I promised at the very beginning of this deep dive that we were going to connect this construction company directly to the AI supercycle, and this is exactly where the battery storage pivot comes in.
The energy transition meets artificial intelligence.
Exactly. We have to talk about power demand. If you look at the macro data provided in the investment memos, the statistics are staggering.
They're almost hard to believe.
Over the prior decade, total U.S. electricity demand grew by a relatively sleepy 5%. But over the next decade, driven almost entirely by the massive power requirements of AI data centers and the broader electrification of the industrial economy, like EV manufacturing and reshoring heavy industry, U.S. electricity demand is projected to grow by 28%.
A 28% baseline growth in national power demand is unprecedented in modern history.
We haven't seen anything like it.
The grid was literally not built to handle that kind of load expansion. And the crucial nuance here is who is demanding that power?
The tech giants.
Right. The hyperscalers, the massive tech giants like Microsoft, Google, and Amazon, who are building these AI data centers, have incredibly specific power needs.
It's not just like turning on a light switch.
A data center running complex AI training models consumes massive amounts of electricity, and more importantly, it cannot afford a single millisecond of downtime.
A millisecond.
You cannot power down a billion-dollar AI training cluster just because a cloud passes over the sun or the wind stops blowing. They require dispatchable, firm capacity. They need baseload-like reliability, 24 hours a day, 7 days a week.
Which exposes the fundamental flaw in traditional solar power. Solar is inherently intermittent.
Obviously, the sun goes down.
It is fantastic at noon on a clear day, but it generates zero power at midnight. So if these tech giants are committed to running their data centers on clean energy, they can't just rely on solar panels.
They need batteries.
Which means they need massive industrial-scale batteries to store the excess solar power during the peak daytime hours and discharge it steadily through the night to keep the servers humming.
Precisely. The battery is the bridge between intermittent generation and baseload demand. And when you audit the internal composition of SOLV's backlog, you see a rapid, aggressive mix shift toward exactly this type of dispatchable power.
They're pivoting to batteries.
Their backlog, associated with battery energy storage systems, or BES, expanded by an incredible 31% quarter-over-quarter.
31% in one quarter?
It jumped from $1.9 billion in Q1 to $2.5 billion in Q2. Battery storage alone now represents approximately 28% of their entire massive total backlog.
That's a huge chunk of the business now.
CEO George Hirschman explicitly noted on the earnings call that the vast majority of their new project originations are now hybrid solar plus storage designs.
So they're building them together.
They aren't just building solar farms anymore. They are building fully dispatchable, tech-enabled power plants.
Here's where it gets really interesting, though, and where the market seems to be fundamentally mispricing the risk.
The tariff situation.
Yeah. If you read the Q&A section of the earnings call transcript, the Wall Street analysts from major firms like Jefferies, RF Capital, and Baird were intensely focused on one specific macroeconomic vulnerability: the Section 232 trade investigations and polysilicon import tariffs.
It was basically all they wanted to ask about.
The broader market has been terrified that new trade scrutiny and aggressive tariffs on imported solar cells from Asia will cripple the renewable sector. And, the logic seems sound on the surface. If the price of solar modules suddenly skyrockets because of punitive tariffs, doesn't that destroy SOLV's profit margins on these fixed-price mega contracts?
That's the fear, yes.
Like, if they agreed to build a farm for $100 million and the panels suddenly cost twice as much, doesn't SOLV eat that loss?
That specific fear is the primary narrative that caused the stock to stagnate and trade sideways over the summer. But a forensic cross-examination of their actual legal contracts proves why SOLV is fundamentally insulated from this risk.
Wait, insulated how?
The Wall Street analysts were aggressively probing this exact vulnerability on the call, repeatedly asking if developers would pause bookings, delay schedules, or attempt to renegotiate power purchase agreements due to tariff uncertainty. But they were misunderstanding the business model.
How so?
SOLV utilizes a customer-procured shield.
A customer-procured shield. Break that shield down for us. How does it protect them in the real world?
It is brilliant in its simplicity. SOLV does not purchase, own, or carry any balance sheet risk for the physical solar modules.
They don't buy the panels.
They operate a completely open architecture procurement model. The contractual agreements explicitly stipulate that the utility and the developer clients, companies like Sol Systems, Aravon, or NextEra, must directly procure, finance, and furnish the highly expensive solar modules.
So the client buys the panels, not SOLV.
The client buys the panels. SOLV simply provides the engineering, the civil installation, the electrical balance of system, and the skilled labor to assemble it all.
So if the price goes up,
If the price of a solar panel triples overnight because of a Section 232 tariff or a supply chain bottleneck, that massive price shock is completely absorbed by the asset owner. SOLV's balance sheet is untouched. Their construction margins remain perfectly intact.
I love this. It completely flips the risk profile. It is like bringing your own highly expensive rare ingredients to a Michelin star master chef.
Oh, that's a good comparison.
Yeah, you want a white truffle risotto. If a global shortage causes the price of white truffles to suddenly triple, the chef's labor margin for actually cooking the meal doesn't change at all.
Right, because the chef isn't buying the truffles.
The diner absorbs the entire cost of the truffles. They just hand them to the chef. SOLV is just the master chef cooking the meal.
That is a perfect, highly accurate analogy. SOLV is selling their expertise and execution, not the commodity. Furthermore, to entirely put the analysts' fears to rest, management confirmed on the earnings call that 100% of their current backlog projects are safe harbored.
Safe harbored, meaning what exactly?
This means the physical equipment for the next several years of construction has already been secured, paid for, and warehoused by their clients.
Oh, so the tariffs wouldn't even affect the current jobs anyway because the panels are already sitting in a warehouse?
Because of this, SOLV has observed 0 schedule slippages, 0 project cancellations, and 0 requests to renegotiate contracts due to tariff fears. They have effectively ring-fenced themselves from the extreme commodity volatility of the global solar supply chain.
That is a massive competitive advantage. It removes the biggest existential risk from the equation, and it leads perfectly into how they actually physically construct these massive power plants, which is fascinating.
The actual execution model.
Right. To build these complex, tech-heavy facilities, most traditional general contractors act essentially as glorified brokers.
They sub it all out.
They win the prime contract from the utility, and then they turn around and hire a dozen different specialized third-party subcontractors to do the actual work. They hire one company to do the deep foundation drilling, another company to do the high-voltage electrical wiring, another to pour the concrete, and another to build the substation.
Which gets very expensive very fast.
But every single time a subcontractor is hired, they stack their own 20% profit margin on top of the cost, which leaks profit away from the general contractor. SOLV takes a completely different, much more aggressive path.
They do. They have intentionally built what I would call an anti-subcontractor advantage through a series of highly strategic tuck-in mergers and acquisitions.
So they've been buying out the middlemen.
In the infrastructure space, many companies do M&A just to buy top-line revenue. They buy a competitor just to look bigger on paper. SOLV is doing M&A to build a proprietary, vertically integrated, self-performing infrastructure moat.
Self-performing, meaning their own guys do the work.
Their strategy is to directly employ the specialized craft labor required to build every single critical component of a gigawatt-scale power plant.
Let's map out exactly who they have acquired to build this moat. Because when you look at the specific companies they bought, it is like watching someone assemble a perfect puzzle.
It's a very deliberate strategy.
First, you have SDI Services. They acquired them to secure direct control over geotechnical pile foundations and deep subsurface drilling.
Which is an absolutely critical phase of construction. When you are building a 1,000-acre solar farm, you have to drive hundreds of thousands of steel piles deep into the earth to support the tracking systems that move the panels.
Right, they have to anchor them into the ground.
If you hire a subcontractor and they hit an unexpected shelf of solid bedrock, they will halt work, declare a change order, and demand millions of dollars in extra fees, which ruins the project's timeline and profitability.
But because SOLV owns SDI,
By owning the specialized drilling labor and the heavy machinery directly through SDI, SOLV de-risks the foundation phase and captures that margin for themselves.
then they acquired Spartan Infrastructure. Spartan brings high-voltage transmission line construction in-house.
Which is huge.
You can build the biggest power plant in the world, but if you can't build the massive steel transmission towers to connect it to the grid, it's useless. Then they merged with CS Energy, which gave them a massive regional EPC footprint and a direct hire workforce in the highly regulated Northeast and Mid-Atlantic markets, saving them from having to build that regional presence from scratch.
Instant geographic expansion.
But the most recent acquisition, which closed right at the end of the quarter on July 1st, is Roberson Waite Electric. This was a $40.9 million acquisition. Why was Roberson Waite so uniquely strategic for their long-term vision?
Roberson Waite is the missing puzzle piece for their complex grid integration strategy. They bring deep, long-standing, multi-year master service agreements with the major California investor-owned utilities.
California is a huge market.
That alone is incredibly valuable. But more importantly, their specific technical expertise is in turnkey, utility substation construction, and complex urban battery storage deployments.
Substations, okay.
Think of a substation as the massive, complex on-ramp to the highway for electricity. It steps up the voltage so the power can travel hundreds of miles.
Okay, so let's look at the complete picture now.
If we connect this to the bigger picture, it's incredible.
Right, SOLV can survey the land and drill the deep foundations using SDI. They can build the sprawling solar array and battery housing with their core EPC field teams. They can construct the highly complex high-voltage substation with Roberson Waite. And finally, they can tie that substation into the regional grid using Spartan's transmission line crews.
Exactly.
They maintain absolute control over the timeline and capture the profit margin at every single stage of the value chain without paying a single markup to a third-party subcontractor.
There's a brilliant closed-loop system. They are keeping all the economics entirely in-house. But the economics don't stop when the construction is finished and the plant is turned on.
That's where the O&M comes in.
The investment thesis highlights a built-in operations and maintenance annuity funnel that I think most people completely overlook.
I definitely overlooked it initially.
The massive multi-billion-dollar EPC construction business is really just the customer acquisition funnel for a multi-decade recurring revenue platform.
Wow, okay.
When SOLV finishes building one of these massive utility power plants, they don't just hand over the keys and walk away. That finished project feeds directly into their O&M division. They currently have over 23 gigawatts of capacity under active management, spanning across more than 152 massive power plants nationwide.
And they monitor all of this centrally through their proprietary Sunscreen SCADA software platform, right?
Yes, the SCADA system, supervisory control, and data acquisition. They run a highly sophisticated, centralized operations control center.
So what does that look like?
Picture a massive room with screens monitoring the real-time thermal performance, battery discharge rates, and grid frequency of these plants across the entire country.
Like a NASA control room for solar panels?
Exactly. This software-enabled oversight secures 20 to 30-year... Utilities pay them a fixed monthly annuity fee for routine monitoring and preventative maintenance.
Just a steady drip of income.
On top of that, they charge time and materials fees whenever they need to dispatch a truck for corrective repairs or emergency response. And eventually, a decade down the line when the technology improves, SOLV is perfectly positioned to capture the lucrative repowering contracts to upgrade the aging inverters or swap out degraded lithium-ion battery cells.
It's the classic razor and blades model, but applied to the power grid. They build the razor for a massive upfront profit, and then they sell the high-margin blades for the next 30 years.
Exactly. It's very sticky revenue.
It creates an incredibly sticky, entrenched, long-term relationship with the largest power producers in the country. Okay, so to synthesize where we are so far, We have established that they have a massive, high-quality backlog. They have the mega project scale to drive unprecedented operating leverage. They have the vertically integrated self-performing moat to protect their margins, and they are completely immune to module tariffs.
It's a very strong operational position.
But none of that matters. Literally none of it if the foundation is crumbling. We need to look at the financial foundation supporting this massive multi-billion-dollar build-out. Because you can have the best backlog in the world, but if you are drowning in toxic debt, you will suffocate.
The balance sheet is always the ultimate truth teller.
Let's start with the capital structure, because frankly, it is pristine. Following their February 2026 IPO, SOLV executed a massive, aggressive deleveraging event.
This is a major defining differentiator when you compare SOLV to legacy diversified infrastructure contractors. Many of their older peers carry billions of dollars in high-interest debt, which makes them incredibly vulnerable to macroeconomic shocks.
Right. If interest rates go up, they're dead.
SOLV took a completely different approach. They used the net proceeds from their IPO to completely retire 100% of their outstanding term debt, which totaled $405.6 million.
Wait, 100%? They paid it off entirely, wiped the slate clean?
Completely wiped it out. So what does this mean for their actual day-to-day liquidity right now as they try to scale up to meet this AI demand?
Yeah, how much cash do they actually have?
It means they have incredible financial flexibility. Today, they have $0 in long-term carrying debt on the balance sheet. By eliminating that massive term loan, their interest expense plunged by 90% year over year.
90% drop in interest expense.
Think about the cash flow implications, that they're saving approximately $50 million annually in pure interest drag alone.
That is $50 million that now drops straight to the bottom line instead of going to bankers.
Exactly. Today, they are operating with a cash war chest of $364 million, plus an untapped, undrawn $200 million revolving credit facility.
So they have plenty of dry powder.
They are funding a nearly $9 billion infrastructure pipeline with zero solvency risk and zero exposure to rising interest rates.
So if the business is humming, the backlog is exploding, and the balance sheet is pristine, what does this all mean for the stock float? Because we have to talk about the Up-C structure.
The Up-C, the elephant in the room.
It is the absolute elephant in the room when you read the dilution risk assessment in these investment memos. If the company is performing so exceptionally well, why did the stock stagnate and struggle to gain traction after the IPO?
It fundamentally comes down to corporate architecture and market mechanics, not operational performance. When SOLV went public, they utilized a specific legal framework called an umbrella partnership C corporation structure, commonly known as an Up-C.
Okay, without getting bogged down in esoteric tax law, what do we need to understand here?
What you need to understand is how the ownership is divided. The pre-IPO owners, which consist principally of their private equity sponsor, American Securities, and the internal company management team, retain 78.6 million Class B units.
Class B units. And those Class B units represent a massive chunk of the company, a 38.9% economic interest in the underlying operating company, correct?
Yeah, and crucially, every single one of those Class B units is legally exchangeable on a one-for-one basis into standard Class A common stock.
Okay, so they can just swap them whenever they want.
So while a retail investor might look at a basic finance website and see a headline public float of 123 million Class A shares, that is an illusion.
Right, because there's hidden shares.
The true, fully diluted share count that you absolutely must base your valuation on is 201.7 million shares.
I want to make sure the listener grasps this because it's vital. It's like looking at a VIP club. The public only sees the people on the main dance floor, the 123 million Class A shares.
Yeah, the public float.
But there's a VIP room behind a curtain holding another 78.6 million people, and at any moment, those VIPs can walk onto the main floor and dilute the crowd. This structure inherently creates massive overhangs, right?
Huge overhangs.
Because private equity sponsors, like American Securities, don't hold public stock forever. It is not their business model. They eventually have to liquidate those shares to return capital to their limited partner.
Exactly. And the institutional market is hyper aware of this dynamic. We saw it play out in real time in June 2026.
What happened then?
The stock had rallied, and the sponsor immediately executed a secondary offering, selling down a massive block of 17.25 million shares at $36 apiece.
You just dumped it on the market.
The market knows this pattern. Every time a stock rallies on good earnings, institutional buyers hesitate, anticipating that the private equity sponsor will simply dump another massive block of shares onto the market.
Which suppresses the price.
This dynamic acts as a temporary artificial lid on the stock price. It is a supply-side resistance that has absolutely nothing to do with how efficiently the company is pouring concrete or wiring substations in the field. It is purely technical friction.
Okay, so that explains the stock price stagnation. But there's another scary-sounding mechanism attached to that Up-C structure that we need to unpack, the TRA.
Right, the tax receivable agreement.
I was looking through the SEC filings, and there is a $240.7 million tax receivable agreement liability sitting right there on the balance sheet.
It looks like a massive debt, doesn't it?
To a retail investor, seeing a $250 million liability suddenly appear out of nowhere looks terrifying. It looks like a ticking time bomb for their cash flow. What is this, and is it going to drain their cash reserves?
It sounds incredibly intimidating, but CFO Chad Plotkin explicitly reconciled this on the earnings call to calm investor fears. A TRA is standard practice in an Up-C IPO. Here is how it works. When those pre-IPO owners eventually decide to exchange their VIP Class B units for regular Class A shares, that transaction generates a massive tax deduction for the public company.
Okay, so they get a tax break when the VIPs enter the main floor.
Yes. The TRA is simply a legal agreement that obligates the public company to share 85% of those specific tax savings back with the pre-IPO owners.
Let me stop you there. So it is paid out of the tax savings they wouldn't have had otherwise, not out of their operating cash flow, right?
Precisely. It is a shared benefit, not a penalty. But more importantly for the near-term investment case, and this is what Plotkin wanted to emphasize, zero cash disbursements occurred in the first half of 2026.
Okay, so they haven't paid anything yet.
Furthermore, because of the complex legal and accounting timelines required to file 2026 and 2027 corporate tax returns, actual cash disbursements under the TRA are legally deferred until 2028 at the absolute earliest.
Meaning they don't have to pay a dime toward this liability for at least 2 full years.
Correct. This means 100% of SOLV's massive operational free cash flow over the next 2 critical years is preserved entirely for organic scaling, funding mega projects, and pursuing further strategic bolt-on acquisitions.
Oh, that's a huge relief.
The TRA is an accounting reality, but it's a complete non-issue for near-term liquidity.
And with the balance sheet secured, the cash flow protected, and the backlog exploding, management was confident enough to upgrade their full-year guidance.
Always a good sign.
They raised 2026 top-line revenue expectations to a range of $3.87 to $3.97 billion, and they aggressively hiked their adjusted EBITDA guidance to $485 to $505 million.
It is a massive, tangible vote of confidence in their back half execution capabilities.
This brings us to the final synthesis of our mission today, the verdict and the execution risks. We've laid out all the complex pieces on the table.
It's a lot of pieces.
We have the revenue surge driven by real physical construction. We have the massive backlog visibility with operating leverage. We have the AI data center demand driver necessitating battery storage. We have the self-performing moat protecting margins and the pristine debt-free balance sheet. Synthesizing all of this, what is the core deep value proposition here for the listener?
You have to step back and look at the valuation multiples relative to their historical peers. At the time these memos were written, SOLV's enterprise value was trading at roughly 10.8 times their 2026 estimated adjusted EBITDA.
10.8.
If you look at historically comparable, best-in-class electrical infrastructure peers, companies like Quanta Services, for instance, they typically trade in the highly premium 18 to 20 times EBITDA range.
10.8 versus 18. That is a massive gaping discount.
It is a profound discount. SOLV has a locked, visible 24 to 30-month revenue runway, absolutely zero term debt, and structurally expanding profit margins as their early-stage mega projects mature and release those contingencies.
So they're undervalued.
The central thesis argues that SOLV represents a massively unappreciated re-rating candidate. The market is distracted by the temporary margin compression and the Up-C technicals.
Right, the noise.
But once those technical overhangs from the Up-C structure and the private equity sponsor clear out over the next few quarters, the broader market should recognize the fundamental intrinsic value of this cash-generating machine and re-rate the multiple significantly higher, closer to its peers.
I think the best summary analogy to apply here, the ultimate framing for anyone trying to understand what this company actually does and why it matters, is to stop thinking of SOLV Energy as a solar panel company. They are not a solar panel company.
Wonderful.
Think of them as the indispensable, debt-free engineering backbone wiring the American power grid for the intelligence age. Think of them as an agnostic toll road.
An agnostic toll road. I like that.
They don't care which brand of solar panel wins or loses the trade war.
Yeah.
They don't care which tech giant builds the fastest AI chip. They just build the heavy infrastructure layer beneath the cloud that makes all of it possible.
This raises an important question, though. We cannot deliver a final verdict without thoroughly cross-examining the primary execution risks.
Of course, it's not all sunshine.
Even with a pristine balance sheet and a massive backlog, no heavy construction company is immune to risk. The sources highlight two specific institutional gating factors that investors must actively monitor.
What's the first one?
The first, as we thoroughly discussed, is the ongoing threat of private equity sponsor sell-downs acting as a temporary suppressive lid on the stock price.
The PE guys dumping shares.
Right. The second risk, and perhaps more important from an institutional capital flow perspective, is the active SOX 404 material weaknesses in their internal controls.
We touched on this briefly when looking at the SEC filings, but what exactly does that mean? SOX 404, it sounds like an error code on a computer.
The Sarbanes-Oxley Act, specifically Section 404, requires public company management to formally certify the effectiveness of their internal financial accounting controls.
Making sure their books are clean.
Right, because SOLV recently carved out from a private equity ownership structure into a massive multi-billion-dollar public entity, their back-office accounting infrastructure is still catching up to their operational scale.
Growing pains, essentially.
Exactly.
Yeah.
The 10Q explicitly disclosed deficiencies in their procure-to-pay processes, their percentage of completion revenue cutoffs, and their IT access controls.
Let's ground that in reality. Procure to pay is just how they track buying materials and paying vendors, right?
Correct.
And IT access controls is just making sure the right people have the right passwords to the accounting software. So they have some complex back-office plumbing to fix. Does this material weakness actually impact the physical construction of the power plants? Are they building faulty substations because of this?
No, absolutely not. It has zero impact on field operations, engineering quality, or physical construction. It is strictly an accounting and reporting issue. However, it acts as a severe institutional gating factor.
Why? If it doesn't affect the concrete, why do Wall Street institutions care so much?
Because many large institutional funds, major pensions, and rigidly structured index tracking ETFs are strictly prohibited by their own internal compliance mandates from investing capital in any recently public company that carries active SOX 404 material weaknesses.
Oh, they legally can't buy the stock.
It is a blanket rule to protect their downside.
Yeah.
Management has a formal aggressive remediation plan currently underway, overseen directly by an executive steering committee.
So they are fixing it.
But until they finalize that remediation and achieve a completely clean SOX audit from their independent auditors, a massive pool of institutional capital is legally forced to sit on the sidelines and watch.
So clearing that up is a huge catalyst.
Resolving this weakness will be a major catalyst. Once they get the clean bill of health, it unlocks that sideline capital, which could be the primary driver for the multiple re-rating we discussed earlier.
That is exactly why we do these deep dives. You have to look past the flashy headlines of AI and data centers. Sometimes you have to get into the unglamorous weeds of internal accounting controls, percentage of completion contingencies, and up-C structures to find the real asymmetric value.
You really do. You have to read the filings.
Which brings me to a final provocative thought I want to leave you, our listener, with today as we wrap up. If SOLV is effectively an agnostic toll road for power generation, completely shielded from the commodity volatility of solar panels, immune to the AI software wars, how much of this vaunted AI revolution actually hinges not on the brilliant microchips or the complex data algorithms, but on the dirty, heavy-duty foundation drilling and high-voltage transmission lines that companies like SOLV are quietly monopolizing?
It's all built on dirt and steel.
We spend all our time mesmerized by the brilliant software in the cloud, but without the physical grid, without the concrete and the batteries. Without the physical grid, the intelligence age stays completely in the dark. Keep questioning the physical infrastructure behind the technology you use every day. Thanks for joining us in the deep end.